Now you're all getting comfortable. Grab a drink as well, not because you'll need it, but because not because the webinar's going to be that bad. It's actually going to be rather good. A pen and paper as well, and let me share my screen with you immediately. Computer's a bit slow, right? Here we go. So I want to share that screen with you. There we go. Quite a bit to cover in this. I've been giving talks and lectures since 1997. You'll be able to see a whole bunch of my books over my shoulder as well. So this is the culmination of what, 21 years of more than that, 24 years of doing all of this and teaching people and educating them. Okay, so as you all settle in, Robert, thank you very much. Concerned about inflation backdrop? No, because the kinds of stocks that I pick, I'm only looking to pick out of 10,000 stocks, 20 of the very best. Ones which will be most resilient to market fall, should the market fall, and more likely to grow. So overall, I don't need to worry about what I don't need to worry about. Why should I worry about companies that I'm not going to own? Why should I worry about things that don't impact me? Okay, Mark from Surrey, welcome as well. No worries, Bill. I hadn't noticed, so don't worry. Thank you all very much. So let's get on with it. Like I said, grab a pen and paper. First thing, grab a drink of water, close the door, make sure the TV's off. Focus, just focus, because this is important. It's about making money. It's about sorting out your future, sorting out your SIPs, ISAs for 2022. Everybody's highly motivated at this time of year, so don't mess it up. Okay, the other thing is you're going to need a cell phone. In case you don't know what it looks like, they look like one of these. You're going to need one of those to take screenshots. Okay, so let's get on with it. My reasons for investing, as you already know, freedom, fulfillment, funds, and philanthropy, and I'll touch upon all of those. But most importantly, just sorting out my retirement and my son's inheritance, basically. Inheritance sounds grand. The point is, any company, any stock that I invest in, I am asking them to look after my retirement effectively. So if I buy Microsoft or PayPal or Adobe or whatever, I'm asking them to look after my retirement. Therefore, they've got to be the best of the best of the best of the best, okay? That's why I scan 10,000 CVs. That's what I'm doing in this. One of the biggest problems you all face, I'm afraid, is this. This is how most people pick stocks, right? They just randomly, I heard something on Alpesh's webinar. I heard something in a magazine from a journalist, God help us. I read something on the internet. My friend at the pub said something. So you end up with a hodgepodge. So you get paralyzed. You don't bother doing anything. You put your head in the sand. And then somebody somewhere said to you, you should buy and hold stocks forever. So what do? They go up and then they come down. You still held on to it during the losing years as well. Alan, welcome from Scotland. Charlie from Taunton in beautiful Somerset. Barry, we've got as well. Happy New Year. You can send with inflation. We're coming on to it. So that's Alan, Charlie, Martin, Rakesh, Robert, Mark, Derek, all welcome. All of you, and there's more of you coming on board as I speak. The other problem we have, we're going to overcome in this webinar, is people don't know when to let go. So I had somebody yesterday saying, I saw that, yes, you picked Uber and it went up, but it's gone back down again since. Yeah, we don't hold on to things forever. So I'll give you two very simple rules for how long you should hold on to a stock. Okay, very simple process. I like to keep things simple because guess what? We don't have the time for complexity. It's as simple as that. Okay, and overall, in terms of keeping things fairly simple, this is all it's going to be. The stocks, if they go up, we're going to have two types of stocks, quality or performance, and I'll explain what those are. Two types of stocks, quality or performance. If our quality stocks go up, well, we're going to hold them anyway. If our performance stocks go up, well, we hold until time runs out, and time runs out means 12 months. Okay, it's as simple as that, 12 months. And then we do it all again. Why? Because everybody's on probation. Nobody gets to be in my portfolio looking after my inheritance forever. No company gets to be in my team. No staff member gets to be in my team. And it's the same with stocks. Nobody gets to be there forever. You got 12 months to prove yourself. If you don't, you're out the door. And then we start the process again. Okay, so anybody who's ever said to you, you buy and hold forever, they're an idiot. Because forever, you could foresee what's happened in the last 20 years? And you think a company, you're going to gamble that what a company is doing today, it can continue producing those results forever? No, that'd be stupid. Everybody's on a 12-month probation. Okay, it's your portfolio, it's your future, it's your money, it's your pension. Okay, equally, if the market goes down and the stocks fall, if they're quality stocks, I might buy more. And I'll explain what quality stocks are in a second as well. And as for performance stocks, well, if they fall, Either time will have run out, i.e. 12 months are up, or they've fallen 25% from their peak since I bought them, in which case we're out. That's it. That's it. That's simple. Take a picture of that. I will repeat this. I like repeating myself because I think things are better learnt when they're repeated over and over again. So I will repeat all of this. Don't worry. That's going to be our simple process. Why is it simple? Because you've all got day jobs. You've got children. You've got better things to do. One of you's in Malaga. You got the sunshine. Jeff, you've got the sunshine. Okay. What does time run out mean? 12 months. 12 months. I said it once. I'll say it again. This is why I repeat myself, because I'm pretty sure people are watching TV whilst listening to me. 12 months is when time runs out, and then we do the whole process again. And I'll explain all of this as we go through. The other problem we're going to look out for and we're going to solve is this. Paralysis. People see all this data that's available everywhere on the internet, and they're paralyzed to make decisions. You know, I'm giving this webinar. In a way, I'm pretending I'm speaking to my wife. And if I showed my wife this, she's going to say, are you bloody kidding? We've got a 4-year-old kid, a 3-year-old, 3.5-year-old child, and you think I'm going to go through target prices and directors' dealings and free cash flow dividend deals and price to free cash flow and what the hell is all this, Alpesh? No, I'm not going to do it. You do it. I'm going to keep it in a bank account. I'm going to bury my head in the sand. I'm not going to fill up the ISA or the SIP, or I'm going to give it to a fund manager who's going to take away the fees or an IFA. That's obviously what she's going to do. If I show her this, of course she is. So that doesn't solve our problem. Throwing more information as it wouldn't solve the problem. Okay. Charles has asked, how would you suggest retail traders hedge? Hedge what? Okay. If the market falls, what do you want to do? Gamble that it's going to fall ahead of time and go short some index? So what? So you can gamble on the market falling, in which case you're not making or losing, you're just neutral. It doesn't make sense for retail traders to hedge. You think my wife is going to go out and hedge? No. The best hedge are quality companies which won't fall as far if the market falls, and if it rises, they rise more. Guess what? It tends to rise a hell of a lot more often than falling. And if you don't want any falls, get a bank account. That's your best hedge against the falling market, a bank account. Not gambling on, oh, I think it's going to fall this month. Let me go buy some put options or go short on the futures market. No, I don't suggest retail clients go into options trading or into futures trading. What I suggest retail clients do is have kind of companies, which I'm going to talk about, which won't fall as far if the market falls and are more likely to rise if it rises. What do those companies have? What are the common characteristics? I'll share those. First of all, I want to show you one headline which came up recently. Morgan Stanley, buy these 35 stocks now because their steady earnings will help them outperform. You're going to see a lot of these kind of headlines. Don't worry, I'll share what these names are. Only out of those 35, only I think it was 3, and I'll share what those names are. Yeah, there were 3 which were in my filtered approved list. I have a filtered approved list of 10,000 stocks I go through every single month. Go through 10,000 stocks and work out which ones are in that list. Now, I hold those for 12 months. So even though I do the list each month, I don't trade in and out each month. I don't trade my investments. Never trade your investments. Write that down. Okay? I hold them for 12 months, but I keep up to date with the market and so on, right? Do I anticipate a major correction in the coming year? Jemin, I don't know. I don't know. My crystal ball's not better than yours. Okay, what I do know is the market goes up, the market goes down, and the best way to profit from it is have the kind of stocks which, when the market goes up, go up more than the market, and when the market falls, don't fall as far. That, by the way, got Eugene Fama a Nobel Prize in Economics in 2016. Look it up. Fama, Eugene Fama, Nobel Prize in Economics for that piece of insight. And you might have heard of William Sharp. He got one donkeys ago. Similar kind of analysis that instead of trying to work out, oh, it's going to fall, let me short it, you were better off doing what I'm talking about, which is having the kind of resilient stocks, which if the market falls, doesn't fall as far, and if it rises, goes up. We're not going to gamble on, oh, inflation, is the market going to rise or fall? Now, don't get me wrong. When I'm on the BBC and they ask me my opinions, I'll give them lots of opinions on inflation. I've got a master's degree in economics. I can do that. But that's got nothing to do with which are the 15 to 20 stocks in my son's ISA and in my pension pot and why they went up 50% this year and why my pension went up 50% this year. Did I know that was going to happen 12 months ago? No. If you watched me 12 months ago, I didn't know that was going to happen. Otherwise, I would have told you 12 months ago. Guess what's going to happen in 12 months? My pension's going to be up 50%. I didn't know that. I didn't know the kind of companies I have is if they have a tailwind, they'll do well. If they have a headwind they won't. So which were these Morgan Stanley ones? Anyway, just to share them with you, the only ones out of 10,000 which were also on the Morgan Stanley list were these three. That was it. By the way, of these three, I only own Adobe because I can't buy everything. So what does that tell you? Well, it tells you a couple of things. My filtration process is a lot more stringent than Morgan Stanley's and Goldman Sachs. I'll show you those in a second. These, by the way, were all the other ones they gave, and these weren't on my approved list at the time of writing. I did have, for instance, PayPal and MasterCard on my approved list earlier in the year when I bought them. Okay, that was back then, but I'm talking about right now, bang up to date, as in today. Okay, today. These were on the Morgan Stanley list, but not on my approved list. In other words, they picked these, I didn't, right? But I'll come back to some of those names. What are the big banks saying? Now, I've already told you to grab a phone and take pictures. So if you missed that one, you missed it, because I've already told you, please have a phone, take pictures of slides. This is what the analysts are saying for 2022. You've got everybody from 4,400 on Morgan Stanley all the way up to Wells Fargo. Their global head of communication, I keep bragging about this, their global head of communications used to be my assistant. So she's now Wells Fargo global head of communications, and she's been plugging this number. So you've got basically a 25% difference between two Wall Street firms who hire the same people from the same universities and all go and interchange their staff regularly. Can you believe it? And there's a 25% difference. So I don't care what they think. Right? I don't care what they think. Because if they can think everything from 4,400 to 4,600 to 5,100, well, bloody hell, that's useful, isn't it? No, it's not. It's utterly useless, because then I'd be gambling on which one of those numbers is right. That's like saying which bookmaker thought the number, I don't know, the 315 at Kempton's going to come in first and second and third. Well, they all think different things. So I don't care, okay, about those at all, what they think. And I want to teach you that independence of thought. I want you to care only about your own analysis, which I'm going to show you as a suggestion what you should do, which is what gets me my 40 to 50% per annum. I want you to care about your own analysis and not about the rest of the world and all the noise. So if you can develop that level of confidence in the analysis you're doing and know, okay, this is fine, then you're not going to be blown about by, oh, so-and-so said this, so-and-so said that, but they're experts. Let me give them lots of money and pay them lots of fees. They're experts. Because guess what? Your pension's going to get screwed. I'm going to show you the headlines which prove it, and the stories done by the Telegraph and the Sunday Times, which prove your pension's getting screwed by people that you're entrusting. All right, so we're going to remove that. And one thing we're not also going to do, because it's not my approach, is we're not going to gamble on geography. We're not going to gamble on sectors. Okay, we're going to take a bottom-up approach of looking at 10,000 companies and saying which of these CVs should manage, which 15 to 20 of these CVs should manage my capital for my pension, my retirement, and my son or my child's inheritance. And we're not going to gamble on, oh, should it be China? Should it be a bit of Europe? Should it be UK? Because we're not racist in our stock picks. Equally, we're not going to gamble on, is it real estate? Oh, is it healthcare? Well, I see that they've got lots of growth, but they're overvalued. Oh, I know consumer discretionary's got lots of growth, but they're undervalued. Let's go into that sector. No, because it's companies that deliver you profits, not sectors. And you might say, yeah, but sectors help. Countries help. Yeah, but it's the company. Why don't you just go straight to the bottom line, which is the bloody company? Not, oh, to get to the company, I'm going to pick the right country. What? That's like saying, oh, I'm going to pick the right hemisphere, right? Completely irrelevant, right? But people are obsessed over it. Why? Because journalists keep on writing about this crap. They keep getting it wrong, right? That's why they keep being journalists, and that's a problem. Okay, so this is how happy I want you to be. I got this a couple of days ago. Thanks for the reply, but considering I only started investing since June 2020, my portfolio is up 85% in the first year. And we're not talking about investing in some stupid crypto or some AIM stock. We're talking low volatility companies. Remember, this is for my pension. Okay, so I got this email. And so far in the second year, up almost 20% with 4 months still to go. So happy. I remember you once said in your first Zoom call, I'll only mess things up if I do something stupid. Please keep doing the weekly market update, etc., etc. He learned off me in June 2020. Okay, now I know it's been a good year. I know there's been a tailwind, right? If the market had crashed, if it was 1929, I wouldn't have got that email. Duh. Okay. I can't make stocks go up in a market crash. I don't have that kind of witchcraft power over stocks. Okay. What I am saying is our job, my one job is this: simplify everything. So forgive me if I'm going to sound brash and direct, because I'm going to simplify things. You have a pension or savings, example, a SIP, ISA, 401k, depending on where you are in the world. You need to pick stocks to suit your returns. Charlie's asked, do you think Evergrande default will cause any serious issues in the global economy? No, I don't. You have pension or savings and have a SIP ISA account. You need to pick stocks to suit your returns. And we're going to work out what's your returns in terms of risk. And what I often ask my students is this. Imagine a scale from 0 to 10. And imagine zero risk in terms of stocks. Zero risk is a bank account. But in terms of stocks, there is no such thing as zero risk. So imagine least risk is, say, something with 8% volatility, which is a Microsoft, okay? It's about the least volatile stock I can think of, big, safe, okay, as it gets. It's only got 8% volatility, right? You might think there's safer companies than that, but in terms of volatility, which is movement of its share price, 8%, low as it gets. I know because I've looked at the data of 10,000 stocks. There's no others which have lower volatility. And then at the other end on 10, you've got not some tiny little oil mining company or gold mining speculative AIM company. 10 I'd call a PayPal with a 24% volatility. Okay, so it's still big and massive, but you know, that's our universe, 0 to 10 in there. And I ask people, where do you sit on that? Most people say I'm a 5 or a 6 or a 7. So we'll work it out based on volatilities and all the other factors. We'll look at stocks which suit your personality. Then you're just going to monitor it for 5 minutes each month because you're going to hold them for 12 months. And I'll show you the data from Goldman Sachs, why it's going to be 12 months. And we repeat that annually with new picks. Now, the stupid thing people do is they say, oh, last year this stock went up a lot for me, so I'm going to hold on to it because the stock market knows I've bought it and they're going to do me a favor and do really well for another year because I own it and I'm special. That's not how the stock market works. Just because you own it, nobody else gives a toss. So after 12 months, go through the whole process of 10,000 CVs again. If you keep hold of it just because you already hold it, there is nothing in any research from Nobel Prize winners to journalists to suggest that just because John Smith owns a stock, it's going to continue going up the next year. All right? Doesn't work like that. Your problems I need to solve in this webinar. You don't know where to start. Example, you might not even know where a SIP or ISA is. Most of you will, but some of you might not. You don't know how to pick stocks. By the way, my wife doesn't really know what SIP or ISA is. So I've had to explain that to her, which is it's just an account you open like a bank account and you buy some stocks in it and they're tax-free, the growth, simple as that. So I explain it in simple terms. You don't know how to pick stocks because I don't want to buy, I want to lose my money. It's for my pension. I said, don't worry. Let's look at the kind of companies which when I explain to you, you decide. I tell her, you decide. I'm not going to tell you what to buy. You decide based on what I show you that, yeah, okay, so if the market were to fall and you wake up at 3 in the morning and go, no, that's all right. Based on its share price compared to its profitability, its sales growth, based on the cash flow it generates, based on its consistent outperformance of the markets, based on the amount of cash it has in the bank, etc., etc. I don't have a problem holding this, even though the market's fallen, because it hasn't fallen as far, because it's so robust. It's where other people put their money into when the market falls. My kind of stock. That's what we're after. Okay. Or you've got advisors who perform miserably. So my problem I need to solve is, what do you say to those advisors? Okay, IFAs or whatever, and they keep charging you extortionate fees. And I'll name some names from the newspaper columns and some of the scandals. You keep doing ad hoc gambling on sectors, fads, hearsay. We're going to stop that. We want to be professional. For God's sake, I mean, look, in my case, it's for my son, right? So I'm not going to say, hey, here, son, go have some crypto, right? Because he's going to turn around and say, Dad, you nut. Right? Thanks for risking my future on it. My job for my family, I'm going to treat you like my family. I'm going to give you the same information and advice I give my family. That's the best I can do. My job for my family is this, these numbers, 12, 15, 25, 40. What are they? 12 months, I'll show you the Goldman Sachs research, which shows why we're going to hold for 12 months. 15 to 20 stocks, I'll show you the research, what shows that will be amply diversified. We will be amply diversified. Okay, with 15 to 20 stocks. You won't need 50. In fact, with 50, you'll underperform the market. You'll have picked too many stocks. And if one of them does well, you'll have too little cash in it because you bought too many stocks, right? 25 is a simple rule, but we can change it, which is if the market drops 25%, if your stock drops 25% from the highest since you bought it, so it might have doubled, and if it drops 25% from doubled, you get rid of it. Now, you can change that. Some people use 15%. Some people sell half their position. We can tweak that to your risk reward, but that's not so important. But we keep one simple rule for now. And 40 is what I target each year. Return, right? Some years you get more. Some years you get less. It's not a bank account, so you're not guaranteed 40%. And on the Goldman Sachs research, which I'm going to share with you on this, 30% a year, longer term, comes just from looking at the cash flow of a company. And I'll show you the formula they use for their private clients. If you've got $50 million, they'll do it for you. I'll do it for you for free on this webinar. All right, because I took their slides, did the calculation, and I'll tell you which stocks I like off the base of that. So that 30%, not every year guaranteed. When the stock market crashed in 2008, nobody got 30% or 40%. Okay, so just so you understand, stocks are not guaranteed, right? My job is to turn 10K to 100K to $1 million for my family. Every 10K into 100 into $1 million. How long does that take? I'll explain the maths on that. With all of this, I'm going to give you mathematics. I'm going to give you the research on it. I'm going to show you the data. Okay, for my students, I give them little medals. Each time they get 100% return, I give them a medal. All right, and I send it out to them. So in the case of Ravi, out of what I taught him, he looked at the data I gave him and he picked Medifast, Etsy, Crocs, Brent Crude Oil, which is a separate strategy, and he got 100% return on all those. Yeah, happy little boy. Okay, as well. Okay, now, one thing as an aside, I say on all my webinars, because it makes a difference, and I've seen it make a difference because people have gone on and listened to me on this, and forgive me for saying this to you. I happen to be co-chairman of the Lumbar Foundation. I have for 15 years. It supports widows and orphans. Lord Billamoria, the chairman of the Confederation of British Industry, is my co-chair on that, and you'll see a few other names on there. Whether it's this or any other cause, once you've shored up and you've got good returns from what I'm teaching you, and you think to yourself one day, wow, that Alpesh, oh no, really, thank you, Alpesh. I made more than I thought. Think about doing something useful with it. It doesn't have to be this cause, it could be anything. Forgive me for virtue signaling, call it what you want, patronizing you, whatever. But think about it, because this is the easiest hard money you'll ever earn. So if you do get a bit of a windfall, maybe like Ravi, you'll get 100% return on some stocks, far more than you anticipated. Think about somewhere else to put it, because it'll be very fulfilling if you do. So how did we get a 50% year? And not every year is going to be 50%. I wish it was. How do we get a 50% year? Excuse me a second. It's me turning off the sound on that. How do we get a 50% year? Well, we had a tailwind from the market. Those years we get more than our 40% target, great. It'll make up for the years when we get under our 40% target, right? I wish you all the same successful year I've had, not just a 50%. 2021 happened to be a good year. Didn't lose anybody near and dear. And as you can see, a good year. Okay, so follow me on LinkedIn, by the way. Do that. Follow. Don't ask to connect to the network. I can't accept you if I don't know you. So just follow on there and you'll get lots more information. Also, the stocks I'm going to give you in the process, it's not advice to you personally, because I don't know you personally. I don't know Jamin personally. Would not DCA if the stock drops, but as potential for growth. Would you not dollar cost average? It depends on your risk profile. You're going to dollar cost average if you're more risk averse. If you're more risk loving, you're going to buy all your stocks on day one. So it depends on your risk appetite. If you're risk averse, you're going to put in a bank account. Okay, so you work out on the scale where you are. Totally risk averse, bank account. Totally risk loving, buy everything today. In the middle, dollar cost average. It's not necessary. It's not proven to always be a winning strategy. It is, in hindsight, something you can say, oh, I wish I dollar cost average. I wish I was in a bank account. Oh, I wish I doubled up on everything. Okay, so who you are. This is who you are. The reason I'm telling you this is so you understand this is very much bespoke to you. Some of you are business owners who want cash to work a bigger return for you. That's why you're on this webinar, because you want to know, right, the cash we've got in the company, in our pockets, where do we put it? Which kind of stocks for 12 months? See, we're getting the building blocks of the strategy already, 12 months. Retiree with time to sort out grandkids' inheritance. Others are busy professionals, dentists, lawyers, accountants. I have a lot of those who are cash rich, time poor, and they don't know what to do with their savings. They just don't have the time. My wife sort of fits into that category. Then there's the 20-somethings with foresight to plan now. Very few of those, about 5% of you on this webinar will be the ones who are in your 20s looking to plan for the future. God bless you. I started investing when I was 12 years old. The frustrated saver, I had no silver spoon in my mouth. It was with £100 borrowed from my aunt. The frustrated saver is the final category of person on this webinar with the SIP that the IFA and fund manager have sent nowhere. All right. The FTSE's at 1999 levels. Many of you will have fund managers who are just tracking the FTSE, and they'll be saying to you after 5 years, hey, at least you didn't lose any money. Thanks for the fees. Thanks for sending my kids to private school, but you don't have a yacht. Okay. So that's a problem. We've got to solve that problem. How do we get to the 50% on the 12 months to November? Okay, how do we do it? What were the stocks? Well, if you want to gamble, leave. If you want to double your money by tomorrow, leave. That's not what this webinar is about. Let me break everything down. First of all, I'm going to show you one important thing from Goldman Sachs's retirement survey from 2021, which is this: a hell of a lot more people are having to retire earlier than they thought. How strongly do the below factors affect your ability to save for retirement? You've got credit card debt, you're paying down loans. Part of investing is not just for your retirement, it's to remove these issues, caring, supporting for someone, looking after other people who've got financial hardship, or you've got too many financial expenses. If we, through our investments, can reduce these, then we're able to have the choice to retire earlier or not. That was a key finding from Goldman Sachs's research. You might say, well, I didn't bloody need them to tell me that. Right? I just want you to know, I get why you're here. So what were the 40 stocks? This is the headline. Goldman Sachs shares 40 stock trades to make now with an average upside potential of 45% in 2022. Before I show you all of these, and you might want your phone, you might want it on video because I'm going to go through them pretty quickly. Out of the 40 stocks they picked, I independently had filtered my 10,000, and I'll share the process with you and tell you the ones I own, which ones I like, all the rest of it. Only one of their 40 was in my list. And I was meant to have bought it yesterday. I've not had the chance. I'll have to buy it tomorrow. So just so you know, I've not bought the one. I'll show you which one it was. Only one of them. And it's not a tiny little company. These are all massive companies. So these were their 40. This didn't make my list. Walmart didn't. They think, if you look down here on the screen at any given time, you can see potential upside. According to them, 44%. Not on my approved filtered list. Why? Well, because my rules are more stringent than theirs, even than theirs. I'll run through these. Foot Locker, they think 76% up in 2022. I don't. Eastman Chemical, 47%. It's not that I don't agree with them. It's just that I think that there are others with less risk give me the same return. I want the highest possible return with the lowest possible risk, don't I? This is another bunch, 69%. Don't go buy these. Alaska Air, they keep banging on about it. They've been banging on about it since it was $70, and now it's at $46. So they've decided, whatever. Since it was at $70, it's now at $55, and now they're banging on about it even more. It's not made my approved list. Okay. This one, DraftKings, they think will double up. I don't. I'm not gambling on a stock just because it's fallen. I'm not gambling on a stock just because Goldman's like it. And I want to teach you a process whereby you'll be that independent-minded, that confident with your pension to be able to say, no, it didn't meet my valuation, revenue growth, cash flow growth, consistent outperformance of the market criteria. It didn't tick every single box of value, growth, income, momentum. Okay, consistency, value, growth, income, momentum, consistency. It didn't tick every box. Therefore, I don't care that Goldman Sachs said this or Jim from the pub said it. I'm not getting into it. All right. Zimmer, 46%. I'm going to run through these pretty quickly. 95% for Penn. Doesn't mean I'm going to get it. Okay. Stuart said, do you only buy US stocks? Nope. Out of my 10,000 stocks, there's US, there's UK, there's global. Okay. All in there. But they're all either listed on the US markets or the UK markets. I only buy them if they're listed on UK or US because that's 10,000 stocks. I don't need to have 20,000 go and open a Vietnamese account, do I? Okay, right. So running through these really quickly, and I'll tell you which one was on my list. Like I said, you might want to record this on your video or just take pictures. Dick's Sporting Goods, the unfortunately named sporting goods company, approved filtered list. It made my list. It was the only one. Now they think 58%. I don't know whether it'll be 58% in 2022. What I know is it makes my list, and I'll probably buy some of it tomorrow. I'm supposed to have bought it yesterday. I'm just too busy. And nobody else buys on my behalf when it comes into my pension or SIP or ISA. Only I have access to it. So, yeah. Right. Let's go through the others very quickly. Like I said, just because they pick them, big names. We're talking about big names you've all heard of. Deere as well. FedEx, 42% on that one. Jack in the Box, 42%. Now, they might have all sorts of reasons. Oh, consumer discretionary is going to increase, or logistics, supply chain, blah, 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 blah. It doesn't bother me. Value, growth, income, momentum, cash flow, consistency. If it didn't tick every single box, then I don't care. Okay? If it didn't tick every single box, then I don't care. Right? Because it's not about these in isolation. It's comparing them to the universe of 10,000. So you might say, well, why don't they have a tighter filter? That's because I've only got one client, me. 15 to 20 stocks. I have to pick the best of the best of the best. They have more than one client. They've got 10,000 clients. So they've got to give lots and lots of names out there. That's why they do it. Okay. I think that's why they do it. So there's a whole bunch there. I've already told you, please take photos if you need to on all of this. So you can see the numbers. Only one made it for me. And most of these are billion-dollar companies in any event. So me telling you isn't going to make a difference to the markets. Okay, there you go. There you go. Moderna, I think, was the last one. Not on my list because the valuation, the revenue growth, the cash flow, the momentum, the consistency, outperformance, not strong enough. Okay, so which were strong enough? Well, I told you about Dick's. I'll tell you about some of the others. All right, and watch to the end. I'm going to give you a whole bunch of good books to download as well. By the way, somebody just asked me, do you only buy US stocks? No, but for those of you obsessed with British stocks, that's 1999 FTSE and that's 2021 FTSE, and it's at the same bloody level. So thank you for your patriotism, but it didn't do your pension much good, did it? Okay, and I'm not racist with my stock picks, so it's not that I say to myself, no, I only pick Indian companies or only American companies. I don't just pick S&P 500 companies, although I do have triple leveraged exchange traded fund in the S&P 500, but that's a separate story, and we'll come to that later on. Park that for the moment. What I am saying to you is there's a hell of a lot more outside than the FTSE. Okay, what you've got to understand about the fund management industry is this: the retail fund management industry underperforms, and it has been doing for bloody years. I've written in the FT about it. Chris Flood's written about it 10 years ago. All right, and it's going on and on, this underperformance, because their job is to capture as much capital as possible through advertising and so on, because they get paid a percentage of the assets under management. So their job is to maximize assets under management because they get paid a percentage of that, right? As fund managers, they get 0.5% or 0.75%. So they've got to get as much as possible. If they get a lot of money, they can't just put it all into just 15 companies. What they've got to do is say, oh, okay, Johnny, you do UK income. Michael, you do European growth stocks. So they narrow the gene pool of stocks from which people can pick, their fund managers can pick. So what happens? Those fund managers pick from a narrow gene pool and therefore underperform because there's only very few companies they can pick from. In any event, they've got so much capital to pick from that there's very few companies they can invest in without taking them over. So they have a problem which you don't have, but you make it your problem by investing with those fund managers and then underperforming, thinking, oh, he's an expert, it's all right. I don't mind that I'm overpaying him to do nothing with my capital. So my job in this webinar is to give you the confidence and the tools to be able to do it yourself and simplify it so you can do it yourself and outperform these Muppets, right? And this is how they destroy your wealth. Now, if you want the Nobel Prize literature on it, it's Eugene Fama's literature on the fact that those who outperform don't stay consistently outperforming. All right, as fund managers, individuals, fine, no issues, because they don't have the same problems of narrow gene pool selection and so much capital that they're narrowing the gene pool. All right, fees, obviously, well, you're not going to pay yourself fees, so you're fine there. And they know you won't leave. Fund managers know on the whole, people tend not to leave. So as they waste your money away, they know they're onto a good number, you're not. Fund manager is tied to a geography, usually UK, US, whatever. Manager is tied to a style, growth, income, value. Well, we're going to tick every single box. Why would we try and gamble on, oh, this week I think it's going to be momentum stocks. This week I think it's going to be value stocks. Fund manager is tied to relative performance into an index. Well, relative performance does not pay your bills. Absolute cash does. So that's a BS way of picking fund managers anyway. You're giving them excuses to be rubbish. It's like they're slapping you in the face and you're saying, yeah, but it's okay. Poor little fund manager. I'll let him slap me in the face, kick me in the teeth. Fund managers rich, they're paid either way. So they're not exactly motivated. Do you know who's motivated? You are. Fund manager is trying not to lose. They're trying not to lose because they know you won't leave if they don't lose money. But what they're missing out on is the fact that, oh yeah, I didn't lose, Alpesh. Look, we're still at 1999 levels 22 years later. See, I didn't lose. But they're forgetting the fact that you could have tripled, quadrupled, increased your pension tenfold in that time frame. All right. And also they're trying to be a jack of all trades. They're trying to be something to everybody because they've got the biggest possible retail client base, whereas you care about only you. Stop caring about things that don't matter to you. Like, oh, well, how will Mrs. Jones down the road do? Right? Only your portfolio matters. And that's why we're going to make it bespoke to just you. And if you don't believe what I'm saying, go look at this article in the Times. £1 billion cost of sitting in poor funds. So we've got to get over this problem. This is me trying to persuade you to pull your finger out and do it yourself. Now, you're on this webinar, which helps. So I'm going to show you the process. So I need to give you the motivation first. All right? Not just throw you a few stock names. In fact, I've given you a whole bunch of stock names, and I've said, I don't care that it's Goldman Sachs or Morgan Stanley. Let me tell you which ones filter down so they're the best of the best for you. I'm telling you exactly the same stuff I tell my family and exactly the same stuff I use for myself. All right. So this is St. James's get it in the teeth all the time. Big fat fees, fat blokes. Usually it is fat blokes. Honestly, it really is. They're fat and they're men. It's just, I mean, it's just factual, all right? Who are getting fat off taking money off out of your pocket. Another fund, 91. 91 is another one. Cautious managed £1.2 billion total fund is down 11% over 3 years, trailing the industry average by around 17%. Does that sound familiar? Because I bet you, if you look at your workplace pension and you look at who they've given money to, I bet you 91 is one of those funds. And they're cautious managed, and it's down 17%. Honestly, fund managers should be sacked. They should have to go into politics because they're that crap, right? Retail fund managers, I know quite a few of them. They really are dipshits. Honestly, they're the thickest people I've ever met in my life. Yeah. Oh, but Alpesh, no, they can't be. How did they get that job? Honestly, if you can be stupid enough to learn a bit of economics, you can get the job. It's irrelevant to your job. You'll get it. Sorry. This is the poverty gap, therefore, that you're facing, right? That's the UK market. That's over a 5-year period. Take any rolling 5-year period since the Second World War. That market has underperformed these two markets over any rolling 5-year period, right? Okay, that's not to say, oh, Alpesh, all you're saying is buy US stocks. No, that's not what I'm saying. What I'm saying is we need a bigger gene pool than just the domestic UK market. And guess what the good news is? The British government, if you're in Britain, wants you to invest in overseas companies, which is why you can put them in your SIPs and ISAs, because they want you to be rich in your retirement and they don't care which countries' stocks you buy. I want British people to be rich because I'm British. I want those pensioners to earn money from foreign companies, bring that money over to the UK and then spend it in Aldi and Lidl or whatever else. Your overseas companies, but you know what I mean. Spend it in your local high street, right? And be rich as pensioners. So we need to increase the gene pool of stocks. I know I'm laboring the point, but it's so bloody important. Before I show you how we then tick the valuation, the growth, the cash flow, the income, the dividend yield boxes, tick, 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 and 5 minutes a month. Just monitor, see if anything's fallen 25% from the highest it's been since you bought it. And these are the contracts that these fund managers use to get you. They will use a letter. They will use diamonds. They will use a number out of 10. And yet they'll be down 2.3%. They're bloody atrocious, but they get away with it. And, well, I'll give you the best example of the biggest numpty there is, right? Woodford. £9 billion. Oh, but no, it can't be true what you're saying. Because if it was true, nobody would ever give these fund managers any money. Oh, shit. They do, though, don't they? Right? That's me in the FT 2004 when they ran the competition. That's Woodford, number 14. He was that rubbish. It was a bit better than the cat, which was basically picking random numbers in terms of working out where the market's going. And they gave him £9 billion. They built him up, even though he was shit. Honestly, that's the city. That's the city for you. It is that bad. And it's your money that he blew away. Yeah. And guess what? You're paying them 10% to be kicked in the teeth. You didn't know it was 10%, did you? You've all been told the little lie that it's only 0.5%. Oh, it's barely anything in fees, Alpesh. They basically work for free. These fund managers are my slaves. No, they're not. That's £10,000. If you cash in after 5 years, which is their recommended holding period, of course it is, because they've got kids' school fees to pay, then total cost £1,000 after 10. That's 10%. After 5 years, they're taking 10% of your money. Yeah. Didn't know that, did you? You thought it was 0.5%. Oh, that doesn't make sense. Honestly, they told me the truth, did they? That's their own numbers. So how do we get to these? How do we get to 52% for yourself? Well, like I said, it was a good year. It was a good year. These were some of the top performers. Now, did I know Crocs was going to be up 209%? It would increase my money threefold. Did I know that? That's what 200% means. Threefold increase in your money. All right. Did I know? No, I didn't. If I did, I would have bought that one stock and nothing else. So let me just reiterate my ignorance. I don't know which way the markets are going to go in 2022. I don't know which stock is going to go up threefold. What I know is, of the limited number of stocks I'm going to pick from, there's a bloody good probability that I'll get an average return of 40%. How do I know this? Because the damn thing's been happening for the last 20 odd years. Okay, some years more, some years less. In the financial crisis, it was 0%. Yeah, because even I can't make the markets go up. I can't make my stocks go up when the market crashes. If I could do that, I'd be Thanos, right? 319%, 208%. I didn't know those ones were. These were all the ones which went up over 100%. Did I know out of my filtered list? And you can see here, somebody said to me, oh, do you only buy US? No, that's Swedish. That's NASDAQ. So that is American. That's Finnish. Denmark. What is it? Deutschland. Finland, Norway, Sweden, LSE, New York Stock Exchange, New York Stock Exchange, New York Stock Exchange, NASDAQ, Netherlands, Denmark, Belgium. Whole variety. You don't have to buy the European ones if you don't want. What about sectors? Didn't care. One's medical equipment, the other one's personal goods. Can't get more different than that, can you? Right? So those are the ones which went up over 100%. Yeah, but Alpes didn't all go up 100%. No, I wish they did. I'd be laughing if they did. There were some which only went up 50 to 100%. Those are those. You can see a range of countries and sectors. That's why I don't try and pick sectors and countries. I pick stocks. Gives me more opportunity to be bloody right. Okay, wait a minute, Alpes, you're cherry picking. You're only showing us the ones which were up over 50 to 100%. Ha, you clever people, you spotted that. So let's show you all of them. That's the whole list from the approved list over that 12-month period. Yes, there was some which went down, but wait a minute, Alpes. If you're using the same approach for all of these, valuation, growth, income, momentum, cash flow, consistent outperformance, how come some went up and some didn't? Because there's always an X factor. If there wasn't, we'd only pick one stock. Even Warren Buffett picks more than just one stock. I just picked the one which would go up 200%, but I don't have a time machine or a crystal ball that good. Okay, so we're picking from that universe. What are the tools? What are the ways in which we're picking from that universe? And does it matter that the market's at all-time highs? Well, it doesn't matter that it's at all-time highs. This is from JP Morgan's private bank. Because whether you invest on any day or an all-time high, actually the market's at an all-time high, you're better off investing at all-time highs. That comes as a shock. Okay. Alex has asked, are there any brokerages you'd recommend? Vanguard, I think, only offer you things which are their own, so not them. Hargreaves, a bit expensive, but they're all right. AJ Bell, Barclays, Halifax, don't really bother me, any of those as well. Yeah, I'm not surprised Bloody Dix was up 4.3% yesterday. I should have bought it yesterday because I've been banging on about it. Okay, as well. So I'm not worried that the market's at all-time highs. Now, if you're risk averse, you might want to wait a month. You'll have an opportunity cost because if the market goes up, you'll have waited. If it doesn't, you'll go, aha, wasn't I a genius? If, like me, you're young, you got 100 years ahead of you, you're more risk-loving, you go in on day one. Do you see what I mean? Everything can be simplified into, you can change the problem into a more simple question, and that's what we do. Why 12 months? This is from Goldman Sachs. This is their data to show. I'm not going to bore you with the amount of academic data which suggests that 12 months is a better period than 50 years. If we lived in the 1960s, buying forever was fine. In a fast-paced, interconnected world where new technologies can disrupt things so quickly and viruses can spread around the world in 2 seconds, 12 months is a better period in which to hold and then put everything on probation. So what are the factors? These are the factors. Now, this is where it gets complicated. Because wait a minute, Alpesh, this all sounds fine, except how are we supposed to do this? I've got a wife and kids and I've got better things to do than become a fund professional. Okay, so we know valuation is important, but we know it's not the only factor when it comes to a stock. Okay, because the research proves that, and valuation is basically share price of a company, the price of a share compared to profitability, or compared to its assets, what they're worth, or compared to its sales. There's all sorts of ways of measuring valuations. We know valuation is important, but it's not the only factor. And I'd say valuation is probably about 30% of the weighting, give or take, all right? And sometimes it's more, sometimes it's less. Sometimes everybody wants value stocks. But I don't just want value stocks. I don't want to gamble on whether the market likes value stocks or not. I want to tick the valuation box, which means looking at the share price compared to its profits, share price compared to its profit growth. But I also want to look at the growth of the company because I know that growth companies' share prices tend to do better than ones which aren't growing. Of course, there are exceptions to the rule. There are companies which are not growing and are on the brink of bankruptcy, suddenly find an angel. Well, I don't like sleepless nights and taking gambles like that. So on the whole, I want growth companies, and I might end up missing some good companies which are not growing, which turn around and boom, but I'm not in the gambling business. If I wanted to do that, I'd go to Ladbrokes. So I want companies which have got sales growth, profit growth, cash flow growth. And we'll look at these numbers in a second. But I want to tick the dividend yield box. Of all these factors, this is the least important. Okay? I want companies which are generating dividends. It's the least important. It's about 10% weighting. Growth is about 20-odd% weighting, maybe 25% weighting, okay, on that. Momentum. I want companies which in the recent past, whatever the world is throwing at them, whether it's COVID or not, their share prices have trudged through it. Okay, and people have believed in them and bought in them because that tells me something. People are putting their money where their mouth is. That's good due diligence. But it's not the only factor. It's probably about another 20% in terms of weight, or maybe even 15% in terms of weight, as in terms of importance. But it is important. We know it's important because people have done enough research on it. And if you want to look at the research with Daniel Kahneman, Nobel Prize winner, I used to write about him as early as 2000 in my Financial Times columns before he got the Nobel Prize. Okay, then have a look. Richard Thaler's work, Nobel Prize winner. Wrote about him in 2001 in my FT columns before he got it, and in my books, right? And then the statistics. Now you're going to say, well, wait a minute, this still sounds a bit complicated, Alpesh. How do we simplify it? So let me simplify it. But what I'm taking to you now, what I'm saying to you is, we're going to tick every box. That simplifies things. So we don't have to gamble on which of these boxes is going to move the market, because we'll have ticked all the boxes. That's why so many of the Goldman Sachs stocks and the other ones didn't make the thing for me. Okay. Eric, I'll come to yours in a second. Eric, the answer is yes, actually. I can answer that question. Jemin, let me just answer your question. It's a bit more complicated, so I'll answer that. Okay. How do you know what works? How do I know what works? Well, this is one of the many pieces of research we use. You don't have to read all of this. What has worked in investing? Studies of investment approaches and characteristics associated with exceptional returns. I didn't do it. This is not me in a laboratory with a white lab coat. This is me using the research out of investment banks, out of Nobel Prize winners, and collating it all. And having published, I've published all of their research in my FT columns. They've published it. All right. So I don't want you to think, oh, right, Alpesh knows some secret. The rest of us don't. No. This is not some secret. It's just collecting what's already out there and putting it in one place. And like I said, very simple rules. Rule 1, 12-month holding period, then review. Rule 2, if it falls 25%, ignore the 35% bit. 25% from the highest it's been since I bought it, I'd exit. Okay, unless it's one of my 5 quality companies. Now, you can argue the toss with me about whether these 5 are quality companies or not. And you can ignore it if you wish. But I think there are 5 companies which are quality. In other words, they're the ones that when the market crashes, as it did in 2000 and a few years ago, they're the ones with so much bloody cash that people actually put money in them as a safety net. So Meta, Apple, Microsoft, Google, Amazon, you can argue the toss and say, no, you're wrong. Fine. Okay. Rule 3, if the market rises, well, we've got a hold for 12 months, as I've already showed you. And if it falls, even though it's risen 25% from the highest it's been, then you sell at that point. Okay. Simple as that. Very, 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 very simple. You know who I am, and I've published a lot of this stuff. Okay, I have no conflict of interest with you. I'm not a stockbroker. Okay, so I'm not trying to get you to broker through mine. I'm not a retail fund manager, right? Because I think they're con artists. So we have no retail funds. We only have institutions in our funds, and those institutions are Aegon, AXA, ultra high net worth family offices. That's it. All right. So there's no conflict of interest with you. And in case you think I'm saying this new, I'm not. That's 1999. That's my very first column in the FT. I have been shifting virtually all my long-term holdings from UK into US stocks. In 1999, the FTSE is still at the same level it was at when I wrote that column in 1999. My holdings have shot up because I followed what I wrote, and I wrote it. It's published, right? My neck on the block. Thankfully, my neck is fine. So let's first, before we go into drill down into the process, okay, value, growth, income, cash flow, let's just do one other part of the thing, which is how much money are we talking about? Assume you plan to invest over 15 years, and with my help on this webinar and what you're learning, let's say you make 20%, not 40. Let's say you make 20% per annum. Some years more, some years less. Okay. And forget the fact that I'm going to show you how on the Goldman Sachs stuff, 30% comes from cash flow. That's their data, right? So you don't have to trust my data. That's their published data. And I'm going to show you what fits in my portfolio, my son's at the moment on that. Let's say you got 10K. That's all you've got. So you might be in your 20s or 30s. In your 401k, your SIP or your ISA. And you plan to add 500 each month because you're not particularly wealthy. All right. And you will, well, then in 15 years, you'll have 600,000. Hang on. Wait a minute, Alpesh. 10K and I'm going to have 600K in 15 years. Yeah, this is what it's going to look like. Now, the reason most people don't bother doing that is because for the first 4 years or for the first 5 years, you barely notice any difference between the growth and the capital contributions. It only really kicks in around years 8 and 9. Don't be put off. Honestly, years go like this, right? How quickly has 2021 gone? For most of you, I'm sure, if not all of you, you'll say, bloody hell, it just feels like New Year's Day yesterday. And it really does. Okay, so that's my job for my son. He's about here. Okay, he's doing a bit more than that red dot because he was born 4 years ago. He's doing a bit better than that red dot because I'm his dad, right? He's got in his ISA. That's his ISA. We max out his ISA allowance, which is about 900 a year. Sorry, 9,000 a year. right? So by the time he goes to university, he should have about 500,000, probably 1 million in his account at least. And if he doesn't, I'll be disappointed at my own abilities. Right now, assume you plan to invest over 10 years instead. And with my help, again, you make 20%, not 40, 20, all right? Let's say you've got 100K in your SIP or ISA. Right, you got a bit more. Some of you I know have got 1 million. Some of you I know have got 10 million because I recognize some of the names on this. Okay. All right. So Sarwan, you're already doing 20% each year on your SIP. Great. So you should be doing 40 then with my help. You should be doubling it at least. Right. Because if you can do 20 just by yourself without knowing anything that I've just taught you should be able to do 40. Right. But let's just say you only do 20. Right. You plan to add 1.5K each month to your portfolio. Well, you should have 1 million in 10 years. That's the growth there. That's 1 million in 10 years. Gets exciting after about the 4th year. For the first 3 years, looks like nothing much, right? And don't forget, it's not the returns in the up market, like in this market in the last 12 months where there's been a wonderful tailwind, right? When the headwind comes and you realize, shit, I got my 20% off buying a whole load of risky stocks, which went up when the markets were good. Now the markets have fallen. I'm screwed and I've got bankrupt because I've lost all my money. That's when you get screwed. We want the kind of stocks which, yes, of course, when the markets go up, will go up more than the market. Any idiot can do that. Any idiot can get a good return in a good market. We're talking about how do we make sure we protect our wealth. It's not how much you make, it's how much you get to keep, right? So when the markets do fall, yours don't fall as far. That's the kind of stocks we want. Everybody looks a genius in a bull market. Trust me, 99.9% of people who think they're geniuses in a bull market turn out to be idiots in a bear market, right? We've got to make sure that it doesn't fall aside. So how are we going to do that? How are we going to protect that wealth? The wealthy always talk about wealth protection, okay? The poor talk about making money, right? We're not just talking about making money, we're talking about wealth protection. Well, look, there's lots of data like this, but I'm just going to give you one example why I say about 15 to 20 stocks. Now, people who buy funds, a fund manager will have bought 50 stocks. If you buy 5 funds and thinking you're diversified, you're going to have about 250 stocks in your portfolio through that fund manager. You're going to have 5 funds, each with 50 in it. Over diversified, underperforming the market. That's what's going to happen. Can I tell you right at the end, some technology, my hedge fund is going to float on the stock market. That's our ambition in the next 2 to 3 years. I'll tell you that right in the last 10 minutes. You don't have to stay for that, by the way, but I just want to tell you a bit about what our ambitions are. We want to disrupt the retail fund market. The retail fund management market is worth trillions globally, from Australia to Canada to the UK to Singapore, America. It's worth trillions. We want to remove some of these fund managers. We're never going to be able to remove all fund managers, and it's not through some automated system which shoves you into different kinds of index tracking funds. No. So what's our strategy? Let's look at the strategy. Holding strategy is this. Value, we need to tick the value box. Growth, income, cash flow, return, consistency, volatility, outperformance. We need to tick all of those boxes, okay? So I want you to take a picture of that. We need to tick all those boxes. Now, after that, if a guru or a Goldman Sachs or a Warren Buffett or a Bill Gates, and I'll show you what's in their portfolios in a second, happens to own one of our filtered stocks, so we take 10,000 stocks, we put them through that filtration process, and we're left with about 100 stocks. If they happen to own one of those 100, so be it. Fine. Tactically, we might say, oh, I'll buy it because they also bought it. Not the other way around. You don't start off with something Goldman Sachs owns and say, I'll just buy it because they said it. Or some journalist said it and he sounded convincing, so I'll just buy it. No, it starts the other way around. You do your process first, which is value, growth, income, cash flow, return, consistency, outperformance. And I'll come to those, each one of those in a second and what the numbers are. And then we look at the tactics. If we want, we don't have to. We can just randomly pick any 15 to 20 stocks out of that 100. But sometimes people say, well, no, I want to pick which ones are in the hedge funds and in that strategy. So a tactic sits inside a strategy. Got it? Right? Oh, by the way, I promised you the free books. You don't have to even wait to the end to get those. That's where you can go to download the free books. You can just go through there, my friends. Okay. All right. Charles, I'll come to your question in a second. You go to that to download those books, right? Including mine. That one's mine. Investing Unplugged. Right, so let's go back. Investing tactic 1. So once you've got your strategy, value, growth, income, cash flow. Now, I'm going to show you which cash flow measure I use. You're not going to necessarily use the same one, but at least use one. All right. Once you've got those 100 stocks, and I'll tell you which are in my portfolio at the moment. Once you've got those, you might then say, oh, well, let's see what the gurus are buying. Oh, look, Bill Ackman's worth 10 billion. That's what he's worth, 10 billion. Okay, and he's got 7 stocks. He's only got 7 stocks and he's 10 billion. Those are the ones he's got. Oh, he's got one of mine. Right, I think I'll buy it. That's fine. But don't buy it because he's got it. You're buying it because it was already in your filtered list, and tactically you wanted to buy something which one of the gurus had. What if you take a Bill Gates, Carl Icahn, George Soros? This is how many billions they've got. Okay, 1 billion, 293 billion. And these are the stocks they own. So you can take a picture of it if you wish. By the way, off those, I did have Fiserv. I don't have it anymore. My 5 quality stocks I've already mentioned. Well, if you were to aggregate all those gurus, not just those guys, but a bunch of others who are all billionaires and big hedge funds, and I'm not in the category of billionaire hedge fund manager, not yet. Okay, that, by the way, is Amazon, Facebook, Microsoft, Salesforce, United Healthcare, Intel, and so on and so on and so forth. Darker the green, the more people have it. Doesn't mean I'm going to buy it. That's just tactically how you might break it down. Now, tactic number 2 I use, which is not suitable for anybody because it uses leverage, so it's only suitable for me and only me alone in the world, is this. I will leverage on lower risk companies. What's lower risk companies? Well, it'll be something like a Costco. See that return histogram? That's Costco's distribution if it repeats its history. Okay, which means it tends to have a 0 to 50. Well, it tends to be positive after 250 days. Very few companies are like that. Okay, very few. You might say, oh no, in the last 250 days, a lot worse. No, we're not only looking at the last 250 days worth of data. We're going to look at about 3 to 5 years worth of data and statistical movements. Okay, and there's very few like that. Costco is one of them. I'll leverage on that, but I'll only leverage 2 times. Why? Because over a 20-day period, it can be down 17%. So if I leverage 2 times, I'd be down 34%. I'll either use an exchange traded product or a CFD, okay, or a spread bet, whichever way. Still hold for 250 days. Now I tend to do that with my Microsoft. I've got 3 times leverage on S&P. It's only suitable to me. Leverage is not suitable to anybody else other than me because leverage is risky. Okay, so only I should be doing it. Nobody else should ever do it. Right? It's as simple as that. So then tactic number 3, what banks are telling their richest clients? So we look to see Citibank in April 2020. In my webinar, I said it can go from $42 to $70. Why? Because it was at 42. It was in my filtered list. And the analysts, which is what the banks were telling their wealthiest clients, were setting a target of 78. Well, it went up $66. 66% rather. Now, somebody pointed out, you said, yeah, but then it fell back a bit. Yeah, well, we don't just hold it forever. Either 12 months are up or it drops 25% from the highest it's been since we bought it. Okay, so on this one, we got 250% return. Why did we get 250% when it went up further than that? Because if it drops 25% from the highest it's been since we bought it, we get out. So April 2020, you can see the date there, April 7, 2020. So last year, April 7, went from 12 to 30. Why? Because we look at what the analyst said. We don't start off with that. It was in our filtered list to begin with. Then we might tactically look at the analyst. Disney was in our filtered list to begin with, gave us a 73% return because the analysts had said this and we narrowed it down. Uber, 85%. It's dropped since then. Yes, doesn't matter it's dropped since then because we already got out, because once it dropped 25% from the highest it's been since we bought it, we exited. Got it? So it only gave us an 85% return, right? Not 100% return, which is the highest it had been. It had been higher than 100%, right? Got it? Or 12 months were up, whichever comes first. 200% return Viacom. Did I know it was going to go up 200%? No. If I did, I would have only bought that and nothing else. I won't go through all the others. This was United Healthcare, which is only 41% return. Okay, and we'll look at which banks, what was their target, who agrees with them, how good are they at tracking it, how recently did they do it. Obviously, we're going to look at those. Tactic 4, what do big banks tell their clients? Now, this is probably the most important thing. This is from Goldman Sachs. This is the cash flow. This is, if you said to me, give me one factor you think is more important than any other, I'd say cash flow. And it's this. It's called cash return on capital invested. You might use a different cash flow measure. Okay, it's up to you, but you need to use one. And it's cash flow over capital. It's the ability of a company to generate cash. And I think for a moment during COVID, what's the one factor which is going to help businesses? It's going to be cash flow. It's not their profit margins. No point having a bloody profit margin if there's no sales. Okay, so guess what it is? It's not profitability. It's not sales. It is cash flow. Can they generate cash flow? Can they generate cash flow? And what Goldman Sachs discovered, and as a hedge fund manager, you get invited to nice little lunches. And I was invited to a lunch, and Jim O'Neill was sitting next to me, who's now Lord O'Neill, who was chairman of Goldman Sachs Asset Management. And he said, and they pitched this to us because they wanted us to allocate capital to them. I was blown away by this. So like I said, it's not me. I wish I researched this. I hadn't. It's their quantum database. And is it surprising that it wasn't me and it was their guys? Because they're paying their guys about $500,000 a year in the analysts department. I ain't got that kind of money to go around paying 10 people off 5 million just for the research. Are you kidding me? Okay, but I can nick their staff. That's what happens. Welcome to the corporate world. 30% per annum. 30% per annum. Not every year. Look, when the markets crash, they didn't get 30%. So those who want a bank account paying 30%, forget it, right? But on average, over the longer terms, they're taking a 20-year period, 30% per annum. For companies in the top quartile by cash flow. Well, this is why my stocks are more filtered than Goldman Sachs, because I don't just look at the top 25% of stocks. I look at the top 10%. Why? Because it's my portfolio. I'm not doing it for their clients. So I can have just 15 to 20 stocks. Well, I can narrow it down from 10,000 to 100 stocks. The top 100, the top 1% of stocks is what I'll narrow it down to. Okay? Right. What are the big money hedge funds doing? Well, I might look at this if it's in my filtered list. So I'll look to see Carl Icahn, George Soros, what they own. If it's in my filtered list, only then. So I own Globant. I still own it. Okay, I own Cadence. Why? Because it was in my filtered list of value, growth, cash flow, right? The cash flow figure I gave you, which I think is the most important, consistent outperformance of the market. So I look at, for consistent outperformance of the market, I look at Alpha and Sortino. You can Google those in your own time, right? Yes, will I look at hedge fund ownership reports? These are the most popular stocks held by all hedge funds. These are the top 10 buy and sells in the last quarter, right? But if it's not in my filtered list, I don't care. I don't care what's on there. Got it? Okay. Somebody's asked, would I recommend investing in Pfizer? No, because it's not in my approved filtered list. Okay. So Goldman Sachs says, buy these 20 stocks that have the most upside potential right now, including 5 set to surge by at least 50%. So I said to my staff, I said, right, tell me which are in my approved list. And these ones that were in Goldman's list were in my approved list. These I don't hold, but were in my approved list because I can't buy everything. Okay. And these I don't hold and are not on my approved list either. Okay. I told you, they keep banging on about Alaska Air. They're just obsessed with freaking Alaska Air. I don't know why. There you go. Take a picture of it if you wish. I'm sharing them with you. And I said, these are some of the returns from my son's ISA, junior ISA, which I always use maxing out because it's tax-free. Yes, I use leverage on my 5 quality stocks and on things like Costco. I use leverage. PayPal, I use leverage. We also will then cross-refer and just have a look out of interest. You don't need to do this. You're not going to do this. Any hedge funds getting over 40%. Any hedge funds in the last 3 years getting 40% per annum, we look to see what's in their portfolio. So this is what is in this particular portfolio. Night Owl. Okay, they average 57% per annum over the last 3 years. Right, and that's what's in theirs. Doesn't mean I'm going to buy it just because it's in there. It has to be in my approved filtered list. Wall Street, any analyst getting over 40% per annum because 40% is my hurdle rate. Okay, once we pitch my hedge fund to Lakshmi Mittal's family office in Mayfair, they're on Nightingale, Berkeley Square. Okay, they're on Berkeley Square. And I asked them, so what's your hurt? What? And they said the family wants to generate 23% per annum returns in anything they look to invest in. My hurdle's 40%. Okay, it's a pretty high hurdle that they've got, given that they're billionaires. The more money you've got, the harder it is to get more of a return on such a large sum. Anyway, that's that one. Okay, and I will look at this. I will look to see what's the probability. This is a bit of statistical analysis. I'm not going to bore you with it. So yes, I will then compare and say, well, look, Costco, and Oracle and eBay are all in my approved filtered list. But you know what? I'm going to go with Oracle and Costco because the probability of a big loss is greater on eBay. So the person who says, oh, guess what, Alpesh, I got 20% last year. Aren't I great? They might have got it on eBay. The market falls this year. I'm still going to get to keep my money. They're not. And they don't know that. They don't know they're about to get hit in the back of the head by a truck. Okay, because they don't see the falls coming. Whereas statistically, we do see the falls coming, and that's why we'll be biased towards the ones who are less likely to fall. You can look at other filters, other factors. Once it's in the filtered list, you might filter by discount cash flow. We don't tend to do this, but people like to look at these lovely little graphics, and S&P Global is in our filtered list, and it also happens on a discount cash flow to be 41% undervalued. Similarly, Tempur-Pedic. I don't own either of those because I can't buy everything. I reserve the right after this webinar to buy any of these, but I don't at the moment. And they're billion-dollar companies, so you're not going to move the market. I'm not going to move the market. 45.5% undervalued on that one. Okay, that's how we do it. We have a little spreadsheet, value, growth, income, cash flow. I update it each month, not because I'm trading my investments, but just so I can keep up to date. Everything's held for 12 months. Even if it falls out of a value, growth, income of 8 or 9, or even if the cash flow drops, doesn't mean we get out of it. And some people overcomplicate things and they get out of it.